Hello, grade 12s. It's me, Hector Nkosi. I'll be taking you for accounting today. I will be looking at stock valuations. If you've got any questions, you can always email me at nkosihector28@gmail.com. And if you've got any other questions while I'm explaining here in the lesson, you can always comment on your chat box. Okay, I've got two separate documents. I've got my slides and I've also have the what you call the other working sheet. So I'll have to stop sharing and reshare again for the other document. Okay, so now these are the learning outcomes that you need to know by the end of the lesson, right? You must know the comparison of stock valuation methods in more detail. Learners should understand the Fifo method beyond its abbreviation. We're still going to look at that. You need to be able to calculate the value of the closing stock using Fifo method. You need to be able to calculate number of units unsold, cost of sales, and gross profit. You need to be familiar, or you need to familiarize yourself with relevant financial indicators. You need to prepare the trading account in the perpetual and periodic inventory system. Now, guys, I need to pause here. When you do stock valuations, guys, it depends business you are, right? So basically, all the business are valuing their stock depending on what. If you're going to a supermarket, you want to buy meat, milk, or bread, right? You can always ask yourself, okay, let's say you want to go buy the milk. When you go by the fridge there, the milk is there, sitting there. Then you have to, the first thing that you need to check is the what? Is the expiring date. So if you check the expiring date now, like for instance, today is the 18th of May, right? And next week, let's say the milk is expiring next week on the 20 on the 28th of May, and there's another milk that is expiring on the 5th of June. Does it make sense? But the one that is expiring on the 5th of June will always sit at the back. Because now, what is the supplier saying to you, or what is the seller saying to you? The first stock that he or he bought first, it must be the first stock that must be sold first. So that's what first in, first out stands for, your FIFO method. Same applies with the bread, right? So the bread, same thing, right? They'll always put the bread that will expire closer. The one that will expire in 2 weeks' time or in 3 weeks' time, it will always be at the back, right? So basically, FIFO, we're using FIFO in your goods that you expire, right? I think in economics, they call them durable goods and non-durable goods, right? But you agree with me, guys, when it comes to a clothing company or clothing shop or a fragrance shop, or maybe let's say a shoe shop, right? Those things, they don't expire. But however, you can't use five for first in, first out with the clothing company, right? The first jacket or the first t-shirt that you're wearing today, you can also wear it again next year, or you can get it at the shop anytime. Whether 5 years down the line, you can always get it, right? So another thing that you need to look at is the comparison of stock valuation methods, right? So this is what I've just explained to you guys. So here it says the price of stock always changes. Shops do not always wait until are completely sold out before ordering more stock. It makes sense, guys. So it doesn't mean that now in a supermarket they have to wait for milk to get finished. No, they'll stock as soon as customers are coming to the shop, they'll stock. But now the milk that they are stocking, it will come at different dates. But now it's going to be a fair to a seller to sell the milk that is expiring first, if I'm making sense. So on the shelves at any time will be, for example, the same loaf of bread with different purchasing prices, right? When we do stock taking, at what price are we going to value the loaves of bread? Now, when we do what? The stock taking. Remember, what is the stock taking? The stock taking is when you are counting that, okay, when you started your financial year or when you bought um, these items, there were so much. At the end of the day or at the end of the term, it depends when your stock taking is. It depends with the nature of the business. Some stock takings are after 6 months. Some businesses stock taking uh, on a yearly basis. It depends with the business. So the food industry won't have the same stock taking as a clothing industry. Same applies with the shoe industry and stuff like that, right? So now, basically, when we say we're doing a stock taking, it's when we count individually what products do we have on our shelves and how many did we have at the start and how many do we have at that point in time. You are taking down the stock. Then you need to write down. Then you can see whether other what you call other what you call other products are being stolen or not, or other products are still existing, or maybe some of them they were obsolete or stuff like that, right? Sometimes it happens that in a shop some of the products they were used as a display, therefore they won't be counted in as part of our stock, right? Therefore, you just need to know that there are three options at a school level. At a school level are specific identification method, FIFO method, of which is the one that we'll be looking at today, and weighted average. So today I will be looking at FIFO method in detail, like I'll be explaining what is the FIFO method. We'll look at its advantages and disadvantages. We'll look at its example. Tomorrow we'll be looking at a specific identification method. Now, specific identification method, guys, it has to do with when you go to a garage to buy a new car, right? Each car is unique to one another because of a number plate or sometimes of its interior and stuff, right? So that's your specific identification method, right? Then your weighted average, it's when now we use it in your clothing company, the things that last longer, because you can weight and average them and get the average price, right? Then now I need to explain to you step by step, right? So I'll explain your SIM method, of which is your specific identification method. I'll explain your FIFO method. I'll explain also your weighted average method. When the value of stock, when the value of the closing stock is calculated. So you must know that, okay, for FIFO, the value of closing stock, now we're under FIFO, remember? We'll calculate the value of the closing stock. The stock will work out of at a slightly higher price, assuming that the latest price for the goods is the highest price for the year. Okay, I can see maybe some of you are still wondering, okay, what's happening here? It's still language. Up until we start with the calculations, that's where things are going to make sense. Then now, gross profit. In grade 10 and grade 11, you've dealt with your income statement. At this point in time, you need to be able how to calculate gross profit. we know that the gross profit is the first total or the first subtotal that we get in your income statement. When you say your sales less cost of sales or sales minus cost of sales, right? So the gross profit will be higher than the gross profit of the weighted average method in the current financial period, right? These are still comparison, guys, between the three methods, right? Now, let's start with our FIFO for today. FIFO is an acronym for the first in, first out, meaning the stock that is the stock that is bought first will be the first one to be sold out. It represents that the stock bought first is the stock to be sold first. And the stock on hand is the most recent stock, right? The stock on hand is the unsold stock, is the stock that you have in your shelf or uh when you go to any shop, sometimes they'll be like, let me go check at the storage. That's a stock on hand because you haven't sold that. It's still, in a simple English, it's still on hand. You're still holding that stock. You haven't sold it yet. Then the system suits any type of the business, right? It applies the prudence concept. You must remember your GAP principles, right? Your prudence concept. We're still going to look at the internal controls of stock valuations later in the week, this week. So don't worry about it. As the closing stock value is realistic because it reflects the recent price of stock, um, it is more applicable to business that sells goods with shorter lifespan. That's what I said to you guys earlier on, that this one, it will be for goods that I want that has for shorter lifespan. Because to be quite honest with you guys, for a clothing company, or if you are selling a fragrance, or let's say you are selling equipment or furniture or stuff like that, I don't think it's more realistic for us to use FIFO method. Why? Because we know that, FIFO method, it's for food basically, but only food that expire. No wonder I made example of durable goods and non-durable goods, right? Typically, the packing on shelves is the newest stock is packed at the back and old in the front. That's what I explained earlier on when I started with the lesson, when I explained with the milk, when I explained with yogurts, when I explained with your polony, you name them, guys. You know all the food. I don't know what you eat, what you don't know, what you do not eat. Okay, cool. Now, let's look at, sorry about that. I don't know why this cursor is going so fast. Okay. All right. Just hang on, guys. I don't know why my cursor is moving so fast. I'm trying to hold it. Okay. 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 I need to do it like this. Okay. Okay, we were here. So I'm still scrolling down. Just give me a few seconds. So I'm trying to get this page. Okay, cool. So this is your last bullet. It says about FIFO method, the gross profit will be higher than the weighted average. We're still going to look at that when we do the actual calculations, because now when I'm talking, you won't be able to see what I'm saying basically. Right. Okay, cool. Right. Then it says you must know also your financial indicators relevant to the inventory, right? So when we talk about financial indicators, You have dealt with your financial indicators, but there are other financial indicators that they affect your inventory system. This is known as financial indicators of efficiency, which assesses if the management has been effective in managing its working capital. The following is a summary of financial indicator relevant to inventory management: your stock turnover rate and your stock holding period. And I'm sure it's not your first time seeing these financial indicators. Now, let's start with your stock turnover rate. And before I start with the stock turnover rate, both of these both of these financial indicators, guys, are part of your liquidity ratios. Remember, your liquidity ratios, you've got 6 of them, and 2 of them is your stock turnover rate and stock holding period. Now, your stock turnover rate is how many times a company sells and replaces its inventory over a year, basically. And how do you interpret your stock holding period? Stock holding period. Meaning now, how long does a company takes to sell its current inventory? Basically, how long do you hold your stock in your shelves, basically? So we use that financial indicator to see how long. And the rate, how many times a company sells and replaces inventory over a year. Sorry about that. All right, cool. Now, I'm sure you are familiar with these, you are familiar with these calculations, right? So your stock turnover rate is always your cost of sales over your average trading stock. Now, your cost of sales, where are you getting your cost of sales? You can get your cost of sales straight from the income statement, or you can actually calculate your cost of sales by saying what? By saying opening stock plus purchases, plus carriage on purchases, less your closing stock. Or you can get your cost of sales by saying, okay, if I'm given my sales and my markup, you can work backwards to calculate cost of sales. I hope you still remember from grade 10 and grade 11, where sometimes they give you sales, you need to work backwards to get your cost of sales with a markup. So you can get cost of sales in 3 ways, right? It's either straight from the income statement, it can be given, I'll repeat that again, or you can have sales and markup, so you can work from sales and markup and get your cost of sales, right? Or you can use your cost of sales formula that says opening stock plus net purchases plus carriage on purchases less your closing stock. Then here is your cost of sales divided by your average trading stock. Now, how do you calculate your average trading stock? Your average trading stock, guys, remember now, it's when you take last year's trading stock, of which is your inventory, and this year's trading stock, and you divide it by 2. Can you see you are averaging what? Your stock. And you have to multiply that by 365. Always. Right. Now, then we look at the stock holding period. Actually here, guys, you don't have to multiply by 365 for the stock turnover rate. The only one that you're going to multiply by 365 is your stock holding period. Because here the answer must be how many times. It's either it's going to be 2 times per year, 3 times per year, 4 times per year, 6 times per year, and stuff like that. So please, guys, here you don't have to multiply by 365 for this one. So this is just cost of sales over average trading stock, and you keep it like this. Wherever this one, your stock holding period, now this one is a period. That's where you have to multiply by either 12 months if the examiner is asking in months, or you multiply it by 365 if the examiner is asking in days. So now for this one is always your average trading stock over cost of sales, right? I've explained how you get your average trading stock. I've explained how you get your cost of sales, right? That's perfect. Can see a question. Hi, Misty. Um, Nice to meet you. Do you have any question? I can see you are greeting me. Okay. Feel free, guys. If you've got any question, you can send all your queries or your questions in the chat box. I can see someone is already typing on the chat box. I'll be checking at your thingy, at your questions, right? Right. So the possible comments on these formulas, right? The effectively the business can improve its stock turnover, the profit they will make. Compare the figures of previous year to current year. Too high stock turnover, the company can run out of stock, right? But this is still theory, guys. We'll see when we're still doing what you call, you'll see when we're still doing the actual calculation. Okay, someone is asking, can you please tell us how do we get cost of sales again? Okay, I'm going to explain about cost of sales. Okay, someone is asking, what topic are we doing? We're doing stock valuation. Other people, they call it inventory valuation, right? So it's either you call it stock and inventory is the same thing, guys. So it's either you can call it stock valuation or inventory valuation. That's what we'll be doing today. That's perfect. I'm glad that you got that, guys. Right? So now someone is asking, say, how do we get cost of sales again? I said there are three ways of getting your cost of sales. It's either it will be given straight from your income statement. That's number one, right? You can get it from your income statement. Two, you can be given sales and the markup percentage. Then you can work backwards to get your cost of sales. Number three, you can be given your opening stock, your net purchases, your carriage costs, less your closing stock. You can get your cost of sales like that again. So there are three ways of getting your cost of sales. But remember, guys, you'll see as we go, because the whole of this week we'll be doing the stock valuation. So it will make sense as we go. Like on Tuesday, it will make so much sense. On Wednesday, when we do more complex questions, it will also make sense. Thursday, you should be fine, right? Now I'm still trying to explain the concepts as much as I can. Right. All right. Let's move on. So now it says calculating the value of closing stock, right? Of closing stock using units unsold, cost of sales, and gross profit using FIFO method, right? Remember, we're still under FIFO method. We said first in, first out. The stock that you bought first is the stock that will be sold first. Now let's look at this class example. So now, this class example, I have to do it with you step by step, guys. Okay. Remember, in accounting, you will always be given the required. The required sales calculate the following: the number of units unsold, the value of the units unsold, number of units unsold. Here they want the number of units on hand. Here they want value, meaning the amount. What value? We speak about money, value of units unsold. Number three, calculate cost of sales. Number four, they want gross profit. Number five, we must use trading account using periodic inventory system. Now, trading account, you did it in grade 10 and grade 11 when they started to introduce partnerships. But we'll be looking at it again, right? Okay, cool. Now, this is the class example I want us to look at, guys. So I want you to pay more attention. It says, we'll make use of the following example to illustrate the stock valuation through Fifo method and perpetual inventory systems. Remember, guys, in grade 11, you dealt with two systems of inventory. It was a perpetual and a periodic one. What does it mean when we speak about perpetual inventory system and a periodic inventory system? A periodic inventory system now, it's when now, like it's very simple because it says periodic, meaning per period, right? So now it's when you count your inventory per period, right? Then perpetual, every time when you make a sale, you count your stock, right? That's perpetual. Perpetual means now and then. Periodic can be after a month, after 2 months, after 6 months, after a year, depending on the nature of the business. Okay. Then it says the following information relates to iStore for the year ended 28 February 2025. Right. So here, guys, you are given the dates. So you have your opening stock. It's 120 quantity, and the price of the opening stock was 115 per unit. On the 6th, you purchased. On May, you purchased. In June, you also purchased. September, you purchased. December, you purchased. February, you purchased at different prices. And you were told that 950 units were sold at 350 each. And you were also told that 80 units purchased in December, they were returned to the supplier. Right. Now, I want to show you by step how do we lay out this. Now, remember the first question says to you, calculate the following using Fifo method, right? First thing first, they wanted the number of units unsold. So you're always going to have your opening stock. Your opening stock units, because they want the number of units, it's 120 units. Where did you get them? You got them here under quantity table, right? Then now we are moving to the purchases one. You purchased how much? You purchased how much units? So you had 200 plus 246 plus 80 plus 320 plus 238 plus 50. So for the whole entire, you purchased 1,134 units. However, you have returned 80 units in December. So the returned units, you must subtract them, right? So basically, the units that were available for sale for this year, they were 1,174. However, you sold 950 because you were told here that 950 units were sold. So you sold 950. Therefore, your unsold units or your closing stock units is 224 by saying the available units that you have of 1,174 minus the sold units of 950. So the unsold units, it's given by 224. Now, guys, this chapter is very important. This is where you can always score easy marks. This is where you can always get your plus or minus 45 marks in an exam. Okay. Now let's go to number 2, grade 12s. Here it says to you the value of units unsold. Now they want the value of the units unsold, right? So now, so since we have 224 units on hand, we will first remove the recent stock bought first to determine value of stock on hand. So we're going to use the bottom up method, right? So the bottom up method, it works so nicely under FIFO because FIFO says first in, first out, okay? I see a comment, just want to check. Yes, Misty, you are right. We are going to get it in an exam. You are going to get it, well, you are supposed to get it in your June exam, but since we're no longer writing June exams, you are going to get it in your prelim. You are going to get it in your final exam again. Right. So it's definitely coming, guys. Okay, cool. For number 2, it says to you, now, we know that we have unsold 224 units, but number 2 wanted the value of the unsold. Number 1 wanted the number of the unsold units, right? So basically, in September, you had 88 unsold, right? In December, you had 86 unsold after subtracting what? After subtracting the returns. In February, there were 50, right? Then this was 88. The remaining, the second column now is the remaining, right? Then now you have to look here. Then you need to say 88 plus 86. You'll get 174. 174 plus 50 units, you'll get 224. This is the bottom up method I'm talking about. Therefore, now you've reached your target of 224 units. Then you have to multiply it by its value. Because now in September, you bought units at a different price. Same applies in December, you bought units at a different price. So in September, the units were costing you 175 rands. In December, units were costing you 230 rands. In February, units they were costing you 198 rands. Therefore, you say 88 multiplied by 175, you'll get 15,400. In December, you'll say 174 multiplied by 230, you'll get 19,889. 789. In Feb, it's 224 multiplied by 198, you'll get 11,200. Then your total value of units unsold, it's 46,389 rands. Therefore, you have calculated what? Your total value of units unsold. Okay, someone is asking a question. Sir, where did you get the unsold number of units from? Remember the unsold number of units from which one are you talking about? Please be specific because there are so many unsold. Are you talking about the first block, or maybe you're talking about this value of the unsold? Please be specific, okay? If you're speaking about the first block, we got them from the table that was given from the first block, okay? Very good. We got them from the table that was given to us. So let's go back to our table. If you look at our table here, right? We've got 50, we've got 238, and we've got 320, right? We've got those numbers. Sorry. Oopsie. Oh, sorry guys, I don't know what's happening. Sorry. Sorry about that, guys. Um, Sorry about that, guys. I don't know what happened. I think I pressed something. Okay, cool. So this is where I got the units for September 320, for December 238, and for Feb is 50. That's how I got my units. However, here in September, they were 320. But now, remember now, the 321, we know that the unsold unit is 224. So basically, you're using a bottom up, right? Bottom up is you're starting from bottom to top, right? So you're going to have your 50, you must reach 224. So let me explain this. So the last purchase that you made was in February and it was 50 units. So do you agree with me? The last purchase that you made, it will be your closing stock, basically. I mean, it will be your closing units. Then in December, you had 238, but you must less the 80 for the returns. Therefore, you'll be left with, you'll be left with 174. Just hang on, guys. I need to check something. 238 minus 80. It actually needs to be 158, not one, yeah. It actually needs to be 158, right? Then this one, you just use it as a top up, your 88 units. Then what you're going to do, you're going to say this times that, and this times that. Okay. Okay. Number 3 now, it says to you calculate the cost of sales. But because of time, guys, I'll re-explain this tomorrow again because we just have limited time, guys. We just have limited time. I will, however, explain this again. Please, guys, tune in again at the very same time at 4 o'clock. I'll be here. I will try to explain it again. Probably I'll use different colors and stuff. Maybe you'll see where I'm coming from. Right. Okay, guys, thank you so much. Have a lovely evening. I'll see you tomorrow.